Yeah, good afternoon, Ananda. Very good afternoon. Good afternoon, Ananda. Good afternoon. Yeah, without taking much time, I'm going to starting now. So today, we are going discussing about financial management. It's one of the important topic in the financial PhD diploma financial management. So financial management, nothing but how the financial manager is going to managing his funds into different portfolios. So in that way, how that person diversifying into different portfolios, what are the benefits are there, what are the activity, what are the instruments are there to invest money in different portfolios. Let's see here in this topic broadly, we have financial management and overview. Let's see what is the overview of the financial management. Financial management introduction. And here there are in the first block, we have three units are there, financial management introduction, and financial planning and forecasting, time development, TVM. So we will see one by one what are the important overview of this thing. So here, when you see here the financial management and overview, financial management is the process of planning, organizing, controlling, and monitoring the financial resources to achieve an organization objectives effectively. So financial management is the process of planning, how we are going to planning our investment, how we are going to organize it, how we are going to controlling, and how we are going to monitoring. Why we have to achieve organizational objectives effectively. If we are going to having proper planning, proper organizing, and controlling of the complete business organization, and thoroughly we have to continuously we have to monitor about the financial um, organizations. So it plays a crucial role in the business sustainability, growth, and profitability. So here um, there is a crucial role in business sustainability, growth, and profitability. So if you are going to have a proper planning, organizing, controlling, monitoring the financial resources, what are the existing resources are there, then we have to utilize it optimal level. So let's see what is that. What are the objectives of the financial management? So financial management here discussing about wealth management, profit management, liquidity management, risk management, cost control. So wealth maximization. So financial manager is going to focusing on how to enhancing the existing shareholders value, how to increasing their investments, how that persons are going to getting the satisfaction when they are going to uh, maximizing the profit. So once you investing money, so that company financial manager is going to focusing on how to enhancing, how to increase the value of the investments. Profit maximization. Always financial manager is to focusing on to earn the profits only, because any business motto is ultimately uh, to earn the profits only. So here how to maximize the profit. That is one point of the one of the objective of the financial manager, and the liquidity management. So here maintaining the sufficient cash flow for operational needs. So liquidity, as we start a business, we must have working capital. So if you don't have sufficient money, we can't start a business at all. So we can't run the business also. So if you want to start a business, definitely that must be useful to the organization purpose only. So any organization, they need a funds. So if you have funds, then how you are going to utilize in optimum level. That is one kind of thing. So risk management. Any business has a risks. So certainly any kind of business, the identifying and mitigating financial the risks. So any organization needs to focus on the financial risk. So definitely the identifying what are the problems are there, what are the problems will be occurring in the future. So that thing always they used to focus on the financial risks and the cost control, how to reduce the cost of the particular product or service. So there is no proper means, uh, uh, proper reliable uh, product cost, so they can't sustain in the long run. Now, what are the functions of the financial management? So, investment management decisions, capital budgeting. So, here the functions of financial management, nothing but investment decisions, financial decisions, dividend decisions, and working capital decisions. So, majorly these are the functions of the financial management. So, the financial manager is going to focus on an investment decision, how to take the proper investment decisions. So, how to invest the capital into different portfolios, how to allocating that existing resources and how to gathering the resources from different sources. So that is the financial manager uh, um, function and financing the function decisions, choosing the between debt and equity financing. So what is the equity financing? How we are going to where we are going to getting the debts, where we are going to recovering it, where we are going to enhancing our business transactions or activities by choosing best of the best finance activities and the dividend decisions. So dividend is completely determining the profit distribution to the shareholders. So how the company is going to distributing the profit. So definitely the profit must be distributed among the shareholders. Some shareholders definitely they don't bother about the company's profits or losses. They used to own the dividends and working capital management. So how quickly we are going to utilizing that working capital into different situations. So assets and liabilities. To run the business, we must have a cash in hand, that sufficient cash in the bank, manpower, resources. So all these things are important to the organization, and also these are one of the functions of the financial manager. So what now importance of the financial management? What is the importance of here? To ensure the financial stability and growth. Ensure the financial stability and growth. So any financial manager is to focusing on the stability. First of all, they must stabilize and they must have a growth to show the growth and helps in effective resources allocation. So the financial manager is to focusing on how to effectively utilizing the resources and allocating the resources in different portfolios and the supports strategic decision making. So planning, but more than the planning, the financial manager is going to focusing on the strategic decision. Depends upon the situation, depends upon the time, and depends upon the competition, depends upon the demand or not. Whatever the situation, that strategic decision is important to the financial manager, and it enhances the profitability and the risk management. And the financial manager is going to enhancing the financial risk and management. Now, let's see what is the financial management. What is the financial management and introduction? What is financial management? A financial management refers to the strategic planning, organizing, directing, controlling of financial activities within the organization. Yes. So initially we have discussed about this financial management. It refers to the strategic planning, organizing, and directing the controlling financial activities. So it involves managing the financial resources efficiently to achieve business goals, ensuring profitability, liquidity, and financial stability. Yes, here they're involving the managing financial resources. What are the resources are available and how efficiently to achieve business goals. And we are ensuring the financial manager ensures about profitability, liquidity, and financial stability. And what are the key aspects of financial management? So we discussed about investment decisions, financing decisions, and decisions, dividend decisions, and working capital. So investment decision is determining where to invest funds for maximum returns. Maximum returns. So where we can have to maximize. So financial decisions. So choosing the best are between the debt and equity for funding. So we have the company has to show about the um, so dividend decisions. So deciding how much profit that must be distributed among the shareholders. So distributors always so shareholders always thinks about how to get the dividends. And working capital management. So managing short-term assets and liabilities. So managing, so working capital is always for organization. So they must now examples of financial management in action. So imagine a company ABC Limited is there. So they're planning to expand its operations by opening a new manufacturing unit. The financial management team must have what is that? Imagine, just assume that one ABC company is there. So they're planning to expand its operations by opening a new manufacturing unit somewhere at different locations. So the financial management team completely they must have a assess investment feasibility. So select a funding resource source, manage cash flow, and plan profit distribution. So here the assessing the investment feasibility, is there feasibility or not? So they have to focus on not possibility, that is a feasibility. We have to connect it cost benefit analysis to ensure profitability. So we have to assess that investment feasibility. That means how much we are investing, how much we can get the profit. That much of that kind of analysis must be work out on it. And select a funding source. Decide whether to take bank loan, debt financing, or issue shares. So we have to see that. We have to see that bank debt financing and issue shares of the equity financing and manage the cash flows. So cash flows here, the company has enough liquidity to cover the daily expenses. So we have to manage the cash flows, that is inflows and outflows. So how much we have to maintain daily and how much expense is going to be there. So that we have to estimate and we have to maintain sufficient cash flows and how much incomes, how much cash flows are there in terms of returns and plan profit distribution. How to distribute among the shareholders profit distribution. So the profit distribution, they must they must decide how much they have to distribute or reinvest in the business and how much they have distribute as a dividends. So in the organization, they must see all these things. They must and analyze that how much we are going to invest. So by making the strategic financial decisions, ABC Limited can grow sustainably while managing risks effectively. So would you like to more detailed explain on any aspect? So now see, so any company the strategic financial decisions can grow sustainable while managing risk effectively. So we have to maintain the risk sustainably. So all of a sudden the risks are going to be there. The company cannot manage the funds or they can't utilize the resources effectively. The key concepts of financial management. So investment decisions, capital budgeting. A company must decide whether to invest in a new factory or upgrade its machinery. Techniques like net present value and internal rate of return IRR helps determine the profitability. So any company, if you're going to investing, if you're going to plan, we must look about the techniques. That is the modern capital budget techniques, that is net present value and internal rate of return, and also ARR, average rate of return, profitability index. Okay, so profitability index and all these are the important factors in the capital budgeting. So we're taking investment decisions. So example, if a business plans to invest 10 lakh in a new project and expects returns of rupees 5 lakhs over 5 years, we must analyze whether this investment will be profitable or not. So simply what we have to understand here, if you're going to invest in 10 lakh rupees in a business, after 5 years, how much we can expect the results. So at least when we get 5 lakhs as investment, 5 lakh as a profit, so we must analyze whether this investment will be profitable or not. No, financial decision, so capital structure. A company must decide how to raise funds through equity. So through equity, how much funds we can raise. So selling shares or debt, taking loans. Through equity. So company must decide how to raise the funds through equity. So they have to look about the shares, selling shares and debt taking loans. Debt means taking the loans. So example, a startup might choose to take a bank loan debt instead of giving up ownership equity to investors. So they're not going to giving any ownership. Ownership nothing but equity through equity. So instead of that, they're going to. So a company must decide how to raise funds through equity. That is selling of the shares. Or else if you're taking the loans, that is debt. So which you want to. So equity nothing but ownership. Ownership nothing but we are selling our shares. When we're going to selling the shares, that is known as ownership. That means equity. Equally we are distributing that partnership. Or else equally, they are also liable to claim all the financial transactions or financial activities. Now, working capital management, ensuring that a business has enough cash to pay short-term obligations. So we must ensure that for small things or small short-term obligations, we must have a sufficient cash in our hand to ensure that. Example, a retail store must manage its cash, so inventory and receivables efficiently to avoid liquidity issues. So in a retail company, they must manage its cash, so inventory and receivables effectively and efficiently to avoid the liquidity issues. So if you are going to asking something, if you're going to exchanging something, instead of cash, if you're taking selling or certain something, so that means we can't share anything. We can't enjoy the profits. Now, risk and return analysis. So, what is risk here? Risk and return analysis. A business needs to evaluate the potential risks before investing in a new project. So, business needs to evaluate, that is, the potential risks before investing in any project. So, any kind of business, they must evaluate the potential risks. What extent of risks are going to be there? Maybe 90%, maybe 50%, maybe 20%. How much potential is there? Before that, we have to take the decision. Before investing in a new project, we must understand, we must calculate, we must evaluate. After that, we have to take the decisions. Example, a company investing in a international markets considers currency fluctuations and political risks before making financial commitments. So here the company investing in the international markets, how much that we don't know. They're considering currency fluctuations. Because of fluctuations, currency fluctuations and political risks, we have to see that international politics before making financial commitments. So how much we want to invest, how much we want investing, then we have to take the proper commitment. That means that before committing, we must understand what is risk, what is return. We have to understand, we have to evaluate what extent the potential risk is going to be there. Financial planning and budgeting. So companies prepare budgets to control expenses and plan future investments. Any company, they used to prepare a budget at the end of the financial year. Why? Sometimes if there is unexpected is going to be there, they are going to controlling over there. And for future investments, they used to save certain money as a resource in the company. Example, a manufacturing firm sets a monthly budget to control costs and maximize profits. So any manufacturing company, FMCG company or pharma company, any company, they set up a monthly budget. How much monthly budget is required to control the costs? What is cost before finishing all the particular goods? Based upon that, how much we can maximize the profit. So what extent that is going to be possible to maximize the profits. So financial management is essential for every business, from startups to large corporations. It ensures proper allocations of resources, risk management, and wealth maximizations too. We have to ensure that what are the proper allocation of resources and the risk management. What is the risk is going to be there? How much risk is going to be there? And the wealth maximization. How much you are going to maximizing the wealth. So a good financial management system helps business grow and sustain in a competitive environment. So a good financial management system is important in the organization. So how the business is going to grow and sustain in a competitive environment. Now see that into financial planning and forecasting. So what we need, what is required, what is the financial planning for every organization, how they are planning, how they are forecasting, means estimating, anticipating about the future. Now, financial planning and forecasting are crucial aspects of a business management. So, financial planning, so forecasting crucial aspects of the financial management that helps business set objectives, allocate resources, and predict the future financial conditions. So, in future, what are the company fixed objectives are? What are the how they're allocating the resources? How to predict the future financial conditions? So, financial planning, the forecasting are crucial aspects of the financial management. So that helps the business objectives. So this process ensures stability, growth, and informed decisions. Informed decisions making in both short-term and long-term financial activities. Any company they have uh, stability. So how they stable, how they are growing, and that might based upon the what kind of decisions they involved in the short-term and long-term financial activities. financial planning. So financial planning is the process of determining how a business will achieve its financial goals. So financial planning is the process of determining how a business will achieve its financial goals. So financial planning, they must achieve the financial goals. So how what is the process going to be process beyond this? So that's how to understand that we have to look at the business organization type. So it involves assessing current financial conditions, setting objectives, and creating strategies for revenue generation, cost management, and investment. So any company, they're involved in assessing the current financial conditions. What is the current financial conditions of the organization? How they are setting objectives for the long term or short term? How they are creating the strategies for revenue generation? So is there any new kind of strategies are there? Existing strategies are by and changing any strategic conditions for time to time, and also how it is the cost management, how they're managing the cost and the investment. So these are the financial planning objectives. Now, once see the objectives of financial planning is that ensuring adequate funds. So any organization, they have to adequate funds. So they have to maintain adequate and sufficient. So making sure the business has sufficient capital for operations and growth. For long-term purpose, they must have sufficient funds. Sufficient capitals. So they must need a sufficient capitals. Efficiently optimizing resource allocation, how we are going to allocating the resources optimal level. So efficiently distributing financial resources to maximize the returns. So efficiently we have distributed the financial resources to maximize the returns. So risk management. Identify the risks. So identifying financial risks and creating strategies to mitigate them. So we have to look at about the financial risks we have to anticipate and what are the uh, mitigating strategies are there, and increasing profitability through better planning and investment. That is profit maximization. So that financial management increasing the focusing on increasing profitability through better planning and investment and ensuring financial stability. So they're maintaining a balance between income and expenditure. So income and expenditure. So what is the stability? What is the income? What is the expenditure? How they invested? How it is the uh, how they're balancing income level and expenditure in both ways. So how they are going to utilizing the resources. So any organization, they're ensuring that financial stability. So maintain the balance between income and expenditures. Now let's see the types of financial planning. So the types of planning here, two types are there: short-term financial planning and long-term financial planning. So short-term means up to 1 year. It is below 1 year. It includes budgeting, cash flow management, and working capital management. So short-term purposes for every financial year, they are calculating the budgeting and the cash flows, inflows and outflows, how they're managing, what is income, how they're investing, and how they are, getting the returns and revenues. And working capital means nothing but any organizations, any parts, then if they are doing any work particular project, they must have it. sufficient spring amount in their hand to utilize the resources. So always don't depend upon the liquidity. So if you are going looking at liquidity means we are exchanging that value, that existing resources we are selling in the market, or else we are going to taking loan. So instead that we must have a sufficient surplus working capital in hand to run the business operations widely or without any disturbance. So long-term financial planning for 3 to 5 years, over a 3 to 5 years is a long term. So it includes a capital investment decisions. So how much we are investing and based upon what factors are decided and involved to take the decisions. And debt management. Debt management sometimes that some uh, borrowings are also some debtors. They may not clear their debts in on time. Sometimes the debt may come under the bad debts category. So that time the company may not run proper business activities. So the reason we have to understand that we have to estimate that what is the debt management. So as a financial manager, they have to take that financial debt aspects and also expansion of these strategies. So time to time, that financial manager they used to plan about the strategies. So if you're taking particular strategy, that means that the impact upon the sales, and the impact upon the revenue, impact that must be impact on the company's growth. So that we have to change that strategies. Always we have to focus on these strategies. That means who are the competitors to the particular organization and where we are going to lacking, where we are going to investing more, where we are uh, draw getting a draw back in the particular segment. So we have to understand, we have to repair it, we have to alter it, or else we have to modify it. Then we may get the profits by using the particular strategies. Now, example of financial planning. So here, one retail company is a uh, the company is there, they want to expand its operations by operating 10 new stores in the next 5 years. So, for example, like a Jepto, like a Blinkit, they want and start a business operations for long term. So they want to operate in a different locations. It's in Hyderabad as example. So the financial plan will include estimating the total cost of expansion. That means what other land is required, real estate, and what is the inventory and salaries. How much they can, how much that is going to be there. So inventory means the stock. How much stock we have to maintain it for 3 months or 6 months or for 1 year. So estimating the total cost of the expansion. So real estate inventory, we have to look about the land and stock inventory and also how much salaries are going to be there to the employees. So, and the second point is that identify the funding sources. What are the funding sources? Identifying the funders, loans from the banks, from the public, or from the NBFCs, and the equity investment. For example, if we are not able to run the business, so we can offer the shares. You can offer the shares. So if you are going to thinking about if you're taking borrowing loan from the public or else banks, at the same time, if there is no sufficient funds received from the bankers or the lenders or the creditors, then you can sell the shares, equity shares, then invest that investments and forecasting that expected revenue from the new stores. So you can estimate, you can anticipate how much revenue is going to be come from the each store. You're going to expanding 10 uh, stores in the next 5 years. So how much you want? So every uh, thing we must need a that planning that we have to forecast. So if it depends upon the forecasting, then only we can uh, get the we can get the profit, or how we are going to getting the profits, and how much we are going to taking it. So depends upon the forecasting. So that means estimating. So we have to anticipate about how much revenues will come from each store. Means, for example, 1 lakh from one each store means 10 lakhs uh, from the each store per month. So in that way we can understand, and we have to estimate the proper um, um, business operations for the long run. Now another point is financial forecasting definition. What is forecasting definition? Let's see. Financial forecasting, it is the process of predicting a company's future financial performance based upon historical data, so market trends and economic conditions. So we have to see that we have to understand that future performance based upon the in the based upon the historical data. So year by year, that means we are going to getting some data. Maybe sometimes maybe increase, sometimes maybe decrease. So 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 Mm. So it helps in making informed financial decisions and preparing for uncertainties. So companies, they used to focusing on the historical data and market trends and economic conditions. So company always they used to think about mm, what is our previous business over the past 5 years, or the past months. So everything that must be uh, understandable. So that must be um, thing. Now objectives, the forecasting, predicting future revenue and expenses. So estimating how much income and cost a business will have. So aiding investment decisions. So predicting the future revenue and expenses. So what is how much expenses are going to be there and revenues are going to, we have to predict it. So estimating how much income and cost business will be have. So how much revenue will come and how much expenses will be there in the future. So that is the forecasting and aiding investment decisions. That means helping companies decide whether to expand investment or cut the cost. So aiding investment decisions means companies has to think about whether is the right time to investment or not, whether it's right time to expand our business operations or not, whether it is the right time to cutting that existing expenditure to reduce the costs. So that is the investment decision. That means we have to focus in the forecasting and managing cash flows. So ensuring enough liquidity for daily operations. We have to manage nothing but working capital. Nothing but working capital. We have to maintain a sufficient liquidity daily operations and risk management. We have to understand. We have to estimate what are the risk and risk are going to be there. Potential risk. We have to identify that thing and financial risks. What are the financial risks are going to be there and that how much that is impacting upon our business activities. So that means we have to assess and we have to mitigate the strategies. Mitigate the strategies. So types of uh, forecasting, financial forecasting. So sales forecasting. So here the sales forecasting is predicting the future sales based upon the market trends. So every company they have different forecasting, that is sales forecasting, expense forecasting, and profit forecasting, cash flow forecasting. So sales forecasting, the predicting that future sales, how much sales are going to be there in the future based upon marketing conditions or trends, and expenses forecasting. So estimating the future costs, operational cost, and profit forecasting. We have to calculate the expected profitability. What is the expected forecast? No, if you're investing 1 lakh rupees for 1 year, how much invest profitability is going to be there at the end of the financial year? Maybe 20% or 30% returns. What is our return ROI, return on investment? So that is the profit forecasting and the cash flow forecasting. So predicting that what is the inflows and what is the outflows are going to be there when you're going to investing certain amount in the business operations. So we have to predicting. Always discussing about forecasting means estimating the future needs and wants and what are the activities are going to be there in the business organization. So example of financial forecasting. A mobile phone company expects to launch a new smartphone model for the next year. So like iPhone, every year they are going to releasing one model. So the forecasting financial performance, it will be analyze past sales trends of the previous year. For example, iPhone recently they released 17 now. So based upon the 1 year sales, how that company has to manufacture for the next year and study the market demand and competitive or competitive strategies. So in future, what are the marketing demand? What demands are going to be there from the public and from the customers point of view? We have to understand. We have to think about the trends. We have to understand the say trends are going to be there in the future. Now, for example, AI is the advanced technology by adapting by all the mobile segments. Let's see future what is going to be there. So sometimes camera, sometimes music, sometimes certain things are going to be there in the mobile revolutions. Now AI is going to be replacing all these things for the futures and estimating the production and the marketing cost. So predict revenue based on expected sales value. So estimate the production and marketing cost. So in future, if you want to produce particular things, we have to reduce the marketing cost. If we don't reduce the marketing cost, that may impact on the revenues. That means that we can't do proper sales value in the future. So this is a glance about the uh, future forecasting. So difference between the financial planning and forecasting. So simply uh, financial planning method, but the process of setting financial goals and strategies to achieve them. So that is the definition of the financial planning. Now, financial forecasting, then estimating future financial outcomes based upon the past data. So past data, how that company was performed over the past 5 years or 2 years or 1 year. Depends upon that they are going to forecasting that or estimating financial outcomes. Purpose of the financial planning, it helps in resource allocation and goal setting. So how the purpose is that how they are going to allocate in the resources and the financial forecasting nothing but helps in predicting financial performance and making informed decisions. So in future, how they are going to predict in the financial performance. Time frame, it can be short term or long term. Financial planning is the short term or long term. So financial forecasting usually short term, 1 to 3 years only. And focusing on financial planning, focusing on the creating a roadmap for financial growth. So that is creating a roadmap for the next business operations, but forecasting, analyzing the trends and anticipate the future performance. They are anticipating about the future performance, about the future, about the future business activities. And example, a business plans to expand globally in 5 years. For example, a new company is there, they're scaling it at the global level, like Flipkart, Flipbook, Meesho, Myntra, Ajio, Nykaa, like that. They're scaling it at the global level. But when it comes to the financial forecasting, the company predicts to a 10% increase in the revenue next year. For example, their market share is about 12% or something is there. Again, 10%, next to 10% is going to be required for the next 5 years or 10 years. That is the forecasting and the financial things. So, finally, the financial planning and forecasting are essential for any business to achieve financial stability and growth. So while financial planning focusing on setting the goals and strategies, financial forecasting helps predicting financial outcomes. So it allowing the business to prepare for future uncertainties. So ultimately, forecasting is the um, estimating that depends upon the previous data, previous experiences, but financial planning explains about the one roadmap for the next 5 years or 10 years. So with this, I'm going to concluding. So tomorrow we will discuss about the time value of money. With this, I'm stopping here. So any doubts, Shiva? Are you there? Shiva, are you there, ma? Shiva, are you there?